Hey everyone, the year is almost over, but your chance to lower your 2025 tax bill, that's not over yet. So today, we're diving into some really smart, last-minute tax moves you can make before the clock strikes midnight on December 31st.
You know, it's a question a lot of us have during the holiday rush. Did I miss my chance? Is it just too late to make a difference on my taxes? Well, the good news is no. You still have some power to change your financial outcome for the year.
You really do have significant control over your 2025 tax bill. But here's the catch. A lot of these strategies are tied to a hard deadline, December 31st. Once that ball drops and the new year begins, these opportunities are gone for good.
So what can you actually do? We've broken it down into 6 key areas. Let's walk through them one by one.
First up is one of the simplest yet most powerful strategies, just controlling the calendar. Yeah, it's all about managing when money comes in and when your expenses go out.
The whole concept is pretty simple. Push your income into next year and pull your deductions into this year. So, if you can delay getting a bonus until January, it won't count towards your 2025 taxable income. On the flip side, by paying things like your January mortgage or your property taxes in December, you get to claim those deductions a whole year sooner.
Okay, next, let's talk about your investments. Because even when the market is down, there can be a little silver lining for your taxes. This strategy is all about turning underperforming investments into a valuable opportunity.
Now, the official term is tax loss harvesting, and it's a really powerful tool. You're basically selling a losing investment on purpose to realize that loss, which you can then use to cancel out the taxes you'd owe on your winning investments. It's pretty smart.
And what's really great is how you can use these losses. First, they wipe out any capital gains you have. So imagine a $5,000 gain on one stock and a $5,000 loss on another. Sell both and poof, the loss cancels the gain and you owe zero tax on that profit. If your losses are bigger than your gains, you can deduct up to $3,000 against your regular income. Any leftovers? You can even carry those forward to use in future years. But, and this is a big one, watch out for the wash sale rule. You can't claim the loss if you sell something and then buy back a basically identical investment within 30 days.
Giving to charity is always a good thing, right? But giving smartly can also lower your tax bill. Before the year ends, you can make your generosity work even harder for you just by using the most tax-efficient methods.
This is so cool because it shows 2 completely different strategies based on how your stock is doing. If you've got stock that's gone way up in value, don't sell it. Donate the stock itself, directly. You get this amazing double benefit, a deduction for the full value, and you pay 0 capital gains tax. But if the stock has lost value, you do the exact opposite. Sell it first, claim that capital loss on your tax return, and then donate the cash.
Now, if you're someone whose itemized deductions are usually just a little bit below the standard deduction, a strategy called bunching can be a total game changer. So instead of donating, say, $10,000 every year for 3 years, you could give $30,000 all in 1 year. That lets you soar past the standard deduction, itemize, and get a much bigger tax break in that 1 year. Then you just take the standard deduction in the other years.
And for those of you over 70 and a half, there's an incredibly powerful tool called a Qualified Charitable Distribution, or QCD. This lets you donate up to $108,000 directly from your IRA to charity. It's totally tax-free, and it can even count as your required minimum distribution. But timing here is absolutely critical. Because of something called the first dollars out rule, the QCD has to be the very first money you withdraw from your IRA that year to get the full tax benefit.
All right, this one's a classic for a reason. Maxing out your retirement contributions is a huge win-win. You're saving for your future, and you're lowering your taxable income today. Every single dollar you put into a traditional 401k or IRA is a dollar the taxman can't touch this year.
So for 2025, you can put up to $23,500 into your 401k and $7,000 into an IRA. And as you can see, if you're 50 or older, you get to take advantage of these really generous catch-up contributions to save even more. Just make sure you keep the deadlines in mind. For your 401k at work, your contributions for 2025 have to be in by December 31st. But for an IRA, you get a little extra time. You actually have until the tax filing deadline in April of 2026 to make your 2025 contribution.
Okay, listen up, because this next one is a major, time-sensitive opportunity, especially for homeowners. This one has a hard deadline that you absolutely cannot miss. 30%.
That's what the Residential Clean Energy Credit offers. It's a 30% federal tax credit on the cost of a new solar and battery system. And remember, a credit is way more valuable than a deduction. It's a dollar-for-dollar reduction of the actual taxes you owe.
And here's why this is so urgent. This isn't a phase out, it's not getting smaller. The credit is scheduled to be completely eliminated at the end of this year. To qualify, your system has to be fully installed and up and running by December 31st. This is literally your last chance to take advantage of this massive incentive.
Phew, okay. We have covered a lot of ground. So let's quickly recap the key takeaways and put them into a final checklist you can use as you figure out your last moves for the year.
So here it is, your final checklist. Control the calendar, use your losses, give smarter, boost your retirement savings, and please don't miss out on that solar credit. Each one of these moves can make a real difference, and believe it or not, there's still time to act.
Look, the big takeaway here is that you don't have to do everything on this list. The goal is just to find 1 or 2 strategies that really fit your specific situation. Even a single move can lead to real savings, and doing something is always better than doing nothing.
So, thanks for watching. Now it's time to take a look at your own finances and see which of these moves make sense for you. That December 31st deadline is firm, so the time to act is right now.